But first, let's get to some of the market action that we're seeing this morning. The S&P 500 currently trading just above 5,800 as it hovers near all-time highs. Our next guest seeing that benchmark surpassing 6,000 by the end of the year. But are there some risks that could threaten to disrupt the climb higher? Joining us now, we want to bring in Sam Stovall. He's CFRA's Research Chief Investment Strategist. Sam, it's great to see you. So talk to us just about where things stand today. Lots of questions about whether or not there is enough left here in this market to continue the push higher. Certainly a lot of uncertainty when it comes to the election, when it comes to future Fed decisions, also just valuation concerns right now. What's your read?
Well, good morning, Shauna. My read is that when you look to what typically happens in the final 2 months of an election year, the S&P gains about 3%. And if you add 3% to where we are right now, that puts us slightly above that 6,000 threshold, which I think, in a sense, sort of acts as like a tractor beam pulling the market up toward it. I think the enthusiasm would really come from just the election being over, and therefore the uncertainty being resolved. And if we continue to see improvements in earnings, question then is, what about the Fed and what about their decision in early November? Our expectation is that they will be cutting rates again. And then we just started what's called the best 6 months of the year by the Stock Traders Almanac. And historically, a strong May through October offers a running start to the next November through April period.
Okay, and so how much weight then does the Fed have in all of this if much of it is focused around what's typically taking place post-elections? I mean, we're still amid the Fed just kicking off its rate cutting cycle.
Hey, Brad. Well, essentially, I've been saying that when it comes to rate cuts, wanting is more profitable than having. That in the 6 or 7 times since 1990, when the Fed actually told us that they were making Fed funds rate changes, the S&P gained 18% leading up to that first cut. However, after the first cut, the gain was less than 3%, primarily because, in a sense, we already got what we expected to get. And now the question is, will the Fed be slower to lower interest rates if employment comes in stronger with the non-farm payrolls report on Friday, as it did today with the private read? And if we end up seeing an economy that continues to be fairly strong with a very resilient employment picture, et cetera, the Fed might decide to sit on its hands at either one of these upcoming meetings, November or December. We still think they're going to cut twice, but the uncertainty is out there.
So, Sam, talk to me about what you just said a moment ago. A strong May through October offers a running start to the next November through April period. So looking beyond January, what do you think the next 4 months of 2025 are going to look like?
Well, history says, and I tend to agree with it at this point, that we would probably end up seeing investors continue to focus on the growth groups. The market has risen an average of 7% in that November through April period versus only 2% May through October. But a strong May through October leads to an even stronger November through April. What we have found is that consumer discretionary, we have found that materials, industrials, and technology tend to be the best performing sectors in that forward 6-month period. And the technicals tend to support that at this point. So I would tend to say that heading into next year could be positive, certainly if the election goes the way the market is currently anticipating.